In this video, I'm going to share some data that runs contrary to what you're normally going to hear about investing on Instagram and TikTok. And if you're new to this channel, I help six-figure families and entrepreneurs break the paycheck to paycheck cycle and create an optimal financial system with automation. If that sounds interesting to you, I want to invite you to like and subscribe, as I'm going to be creating a lot more content around this topic. On the internet, we're often feeling a lot of comparison, myself included, about, you don't have multi-million-dollar real estate properties, you don't have Airbnbs, you don't have crypto. And frankly, some of those feel like there's a high barrier to entry. Maybe not monetarily for some of those, more and more nowadays, which I'll get into in a minute, but oftentimes it can feel very difficult to get into intellectually, maybe. Like you don't have the knowledge base, or you're afraid of getting burned, especially with real estate. If you think about the traditional idea of buying a rental property and saving up 20% down, that feels like a big endeavor to go from zero of maybe not having a ton of understanding about real estate to then saving up 20% for a down payment to then getting your first rental property and going through all the hoops and jumping through all that. Conversely, we are living in a time where it's never been easier to invest in things like crypto or stock and bond investing, index funds, mutual funds, etc. The barrier to entry for that is so low. So back in the 80s even, if you wanted to invest in, say, Coca-Cola as a stock, you would have to find a stock broker, someone that had access to the market. Now, however, the barrier to entry is so low that there are places where you can get access to not only Coca-Cola stock or whatever other stock, but a broad amount of stocks within an index fund or a mutual fund for as little as $10 a month. So that is a phenomenal place to be as a new investor. There's not much really keeping you from getting the ball rolling if you're thinking about investing. One of the biggest challenges is that most people are living paycheck to paycheck right now. Inflation is at an all-time high. Wages have not kept up with the pace of inflation for several decades. And so it can feel like, how is anyone even getting ahead? And so what I help people do, 90% of my time is spent on coaching people to set up an automated process to break the paycheck to paycheck cycle. So if you're interested in learning more about that, I've got some links below. There'll be some links at the end of this video that you can check out other videos that I've made around this topic, sharing my entire framework. But regarding investing, I think it's helpful for us, if you're an American watching this, I live in America, it's helpful to know, what does the data suggest that Americans do? So let's take a look at this. This is actually a census report. And what I find so fascinating about this, and you can read this, I'll leave it linked down below if you want to read the whole thing, very fascinating as far as I'm concerned. But this graph that you're going to see is really mind-blowing as far as I'm concerned. And so let me just go ahead and get to it. So let me increase the size here so you can see what I'm looking at. This is a breakdown of where Americans keep their wealth. And 36.2% of Americans are keeping it in retirement accounts. Now, what I find interesting is this is very backing up my own anecdotal experience. When I first started out as a financial advisor, as a young guy in my 20s, I would notice that all these accounts that had mutual funds and all that stuff was retirement accounts. The majority, the lion's share, were retirement accounts. Now, there are non-retirement accounts that people can invest in. They can touch the money before age 59 and a half, and there are some benefits to those accounts as well. But the biggest takeaway, the biggest driver, I think, that undergirds all of this is automation. So back in, I think it was 1979, is when the advent of the 401k happened, and that made it easy for people to get into investing through their employer. So one of the biggest challenges most people face, I'm going to throw a couple stats out here, is that 69% of Americans have less than $1,000 saved. But that's very contrary to the amount of money that is in retirement accounts right now. Again, going back to the title of this video, you think about real estate, rental properties, crypto's not on here. Obviously, that might be harder for the government to get access to. That information, obviously, a relatively new asset class. But the thing I want to drive home here is that retirement accounts, one of the biggest reasons that people have so much of their wealth in retirement accounts is automation, is because when you start a new job, when you go to a new employer and you sign up and do your thing through HR, you're opting in more often than not to your 401k or 403b or thrift savings plan if you work for the government or in the military. And the beautiful thing about this is you don't have to think about it. Your retirement account is not predicated on you choosing every time you get paid whether or not to invest. You've made a decision once, and then automation is taking over and sucking that money into a retirement account before you have the chance to go spend it on something. And so I've been fascinated by this principle for like 15 years when I discovered it. And so that's what led me to create this entire business. The reason I'm filming right now is because of this information. I'm so compelled by it. I know that there are going to be plenty of people that are paycheck to paycheck now and will retire multimillionaires. Unfortunately, just because they turn 59 and a half and step into retirement doesn't mean that all of their financial struggles go away. So what I've spent the last decade building is a system that automates everyone's money, especially difficult for people that have variable income. Think realtors. I was in corporate America in the financial services industry and getting, a salary plus bonuses plus commissions. And so it made it very difficult to manage this kind of unpredictable income each and every month. So another couple points just to be made here. Retirement accounts are not sexy. The average person investing in a retirement account is probably not a super savvy investor. I'd bet to say they are not a savvy investor. There's plenty of other data that I can get into in other videos around, maybe you've heard the adage that it's not timing the market, but time in the market that makes a big difference. So there's a JP Morgan study that you can go Google if you want to check it out, where they show that the market, the S&P 500 as an example, does 7, 8, 9, 10% on average, and the average investor gets 2.8% on average. And the reason is they're trying to time the market. They hear on TV, online that, such and such is a good buy, or you should sell your Apple shares and invest in Tesla or something like that. And that is predominantly noise. You want to just be picking an investment strategy, setting and forgetting it, and sticking to it for the long term. If you've seen enough of my content, you might know the story that I'm about to tell, that Fidelity did an internal study. So Fidelity, you've probably heard of them, but they manage $4.5 trillion. Fidelity did an internal study to survey their entire clientele to see who on average had the highest rate of return. I ask this question all the time on client calls. No one has ever guessed the right answer. I'll tell you the right answer. The people with the highest rate of return are all dead. So think about that for a minute. All the dead clients. The second highest rate of return is people that forgot their password. So we want to save ourselves from ourselves as it relates to investing. We want to pick a strategy and let the strategy work itself out. And our biggest job, the thing that we suck the most at, is putting enough money into these accounts. So again, you can note just a couple other notes here. Home equity is huge. Why? Because you have to pay that mortgage each and every month. If you don't want to be homeless, you're going to make your mortgage payment, and that mortgage payment is going to correlate to, over time, an increase in equity over time. So that, coupled with having retirement accounts and investing in those, are the two biggest drivers per this US Census data to building wealth. And it's great, don't get me wrong. If you want to invest in rental real estate, if you want to invest in crypto even, go for it. I'm not saying that's not an endorsement to go check out crypto, but having a portion of your portfolio in crypto, fun fact, Bitcoin is the highest performing asset class as of late and crushes so many other asset classes. So if you want to put a portion of your dollars in there, no problem for me. But the reality is you need to pick a strategy and stick to it for the long term. Don't be too quick to compare yourself to other people online, especially if they're telling you to invest in some of these more exotic asset classes like crypto or real estate, things that might have a higher barrier to entry. There's certainly a time and a place as you progress as an investor to consider those things. But the nice thing is you can literally start for $10 a month and get into an index fund and begin the journey today. If you found this helpful, please like and subscribe. It's the #1 way you can help me in my mission to spread financial literacy and empower others to take action and master their money effortlessly with automation. If you stuck around this far and would like to apply for coaching where I help you one-on-one set up your own automatic money flow, click the link in the description below. And then lastly, if you want a full video breakdown of my method, click the link here.